Today we're talking about what is a reverse mortgage and how does it work. For many homeowners age 62 and older, a large portion of their wealth may be tied up in the equity of their home. A reverse mortgage can provide a way to access that equity without selling the property or taking on a traditional monthly mortgage payment. A reverse mortgage is a loan designed specifically for eligible homeowners that allows them to convert a portion of their equity in their home into cash. Unlike a traditional mortgage where the borrower makes payments to the institution, with a reverse mortgage, the lender makes payments to the homeowner. That's one possibility. The homeowner can also access their complete equity. The homeowner generally remains responsible for their property taxes, their homeowner's insurance, property maintenance, HOA fees if applicable, and the borrower must continue to live in the property as their primary residence. How does a reverse mortgage work? With a reverse mortgage, available funds can often be received in several ways. Lump sum payment, monthly payments, you can receive monthly payments. You can use it as a line of credit, or you can use a combination of the options. The loan balances increases over time. This is called negative amortization as the interest and fees accrue. Repayment is typically not due until one of these events occurs. The homeowner sells the home, the homeowner moves out permanently, the homeowner no longer occupies the property as a primary residence, they've passed away. At that point, the property is usually sold and the proceeds are used to repay the loan balance. Any remaining equity belongs to the homeowner or to their heirs. Now, there are some common misunderstandings about reverse mortgages. Many people believe that the bank takes the ownership of their property, and that is generally not the case. The homeowner still owns the property, they're still on the title, and they keep the home. The reverse mortgage simply places a lien against the property, similar to a traditional mortgage, with the exception that there's typically no payments due. Another common misconception is that the heirs automatically lose the home. In most cases, heirs can sell the property and keep the remaining balance after the loan is paid off. They can refinance the property and retain ownership of the property. They can walk away if the loan exceeds the home's value. So most federally insured reverse mortgages include protections, so the borrowers and their heirs do not owe more than the home's value. That's very important. Is a reverse mortgage right for everyone? No, it's not. A reverse mortgage can be a very helpful financial tool for homeowners looking to, number one, supplement their retirement income, eliminate an existing mortgage payment, access funds for medical expenses or home repairs, improve monthly cash flow while remaining in their property. However, it may not be ideal for every situation. Long-term goals, estate planning, future housing plans, and overall financial strategy should all be taken into consideration before moving forward on a reverse mortgage. Our final thoughts are: reverse mortgage is not simply free money, but for the right homeowner, it can be a very useful financial tool. Understanding how it works and understanding how it affects the future equity is important before making any final decisions. If you have any questions about your situation and a reverse mortgage, downsizing, selling options, or housing strategies for retirement, there are several paths available depending on your specific goals and needs. Thinking about your next move? Contact me to discuss your options, and we'll take it from there. Thank you for tuning in today.